Welcome back to Cheddar, everyone. U.S. crude oil prices have been sliding for weeks, but have just fallen from above $18 a barrel on Friday into negative territory today. Joining us now to break down this unprecedented slide is Rob Thummel, who is the portfolio manager at Tortoise Advisors. Rob, thank you so much for joining us here today. This was a historic drop, a historic occasion, the first time oil prices have ever gone negative. Explain to us the significance of this and why is this happening?
That's a good question, and I've been doing this for 2 decades, never seen this happen ever. So here's what happened. So basically, we clearly have an oversupplied oil market, right? We have a lot of supply and not enough demand, and we all know that from a macro perspective. But what that's then resulted in is starting to see oil inventories around the world start to rise. But specific to what happens in the futures contracts is the contracts that are outstanding require traders basically to accept delivery of oil in a specific location at a specific time, and that specific location happens to be in Cushing, Oklahoma. Well, there's simply not the inventory levels in Cushing, Oklahoma are rising, and you have a bunch of traders today that had to assess if they're going to take delivery, where are they going to store that oil? There's simply not enough places to store the oil in Cushing, Oklahoma, and so they started selling their obligations to take delivery of that oil, and there weren't any buyers to step in because they have nowhere to store it as well. So for a 1 month contract that expires tomorrow, we essentially had a whole bunch of sellers and no buyers, and that just caused the price to obviously do what it did, which is crater and go negative. Now, if you look at the futures curve, the prices going out into the next several months, the oil price is obviously substantially higher than it is today.
Okay, and so this is not the first time that oil has come into focus during the broader coronavirus pandemic era that has rattled the markets and added uncertainty, volatility. And recently, we've seen a little bit of what is widely regarded right now, at least. It'll only tell in the future if this is actually a dead cat bounce or not, but a dead cat bounce in this situation. And the coronavirus crisis has been the headline story for weeks now. So this slide just happening today, but it has also shown itself in recent weeks as well. I believe it was at the tail end of February, early March that we saw oil also play an outsized role when you had a trade war, or not a trade war, a price war, excuse me, between Saudi Arabia and Russia that put pressure on WTI, but then Brent internationally as well, as that is the international benchmark there. So, how much longer can this play a larger role, and where will investors then line up in terms of oil markets versus trying to dive into other things and set positions in the equity markets as well?
Well, clearly negative oil prices don't work for anybody. But even if you look at the futures curve and where the expectations are oil prices could go, whether it's in the 20s or even the 30s, those oil prices are too low as well. And that was reflected most recently with the OPEC Plus agreement, which is basically going to take a significant amount of oil off of the market, and it's going to take it off the market for an extended period of time. That's really important. So when you look at OPEC Plus, it's going to take at least 10 million barrels off the market starting in May and June, and then 8 million barrels a day for the rest of the year. The U.S. and Brazil and Norway and Canada will also participate, reduce the supply as well significantly. Now, in the second quarter, the supply reductions aren't going to offset the demand destruction that's happened because of COVID. However, in future periods, as demand starts to come back and starts to rise, and those supply reductions remain in place, the equation will flip. We'll have a lot of demand and not enough supply. And so these oil inventories that are building today will actually reverse and get back and trend back to normal levels, which will help oil prices rise back to probably around $40 to $50 a barrel, maybe late to 2020 or sometime in 2021.
And so as of right now, I mean, when we look at the broader markets that are going to be ingesting a ton of data this earnings season, as we saw banks in focus last week. We still have some smaller local community banks this week. Local community banks actually might be a little bit more in focus, given the lending that they're going to have to be doing as well for small businesses and those who might be customers. But then you move into the tech companies that have also been relied on for the rally over the extended bull market run that we just came out of, and are going to be leaned into, it looks like, yet again, to try and get the overall stock market out of the rut, the downtrend that we had seen. Should we be banking on tech particularly once again, or is there some other part of the market that is going to take focus right now?
Yeah, so at Tortoise, we focus predominantly on energy, and here's what I would say: there are some opportunities in energy that are unrelated to oil even. We really like energy infrastructure stocks because if you think about what do energy infrastructure stocks do, they don't have as much price commodity sensitivity as the direct oil producers and oil and gas producers have. The energy infrastructure stocks are providing the critical assets that are really important. In fact, a lot of the storage that's happening right now is being done by energy infrastructure companies that we own. The attractive thing about those companies are that they pay relatively high dividend yields. And if you look at the
Hmm.
right ones and you pick the right ones, we think those are really compelling opportunities. You've got 10% plus dividend yields in a lot of these stocks that we think hold those dividends. That's going to be attractive to investors as we move to the economic phase after COVID, and investors recognize the critical nature and the compelling nature of high dividend yields in a stock market that probably doesn't perform as well as it has in the past.
Well, so thinking about that, summer is usually a peak time for oil prices as road trips, vacations, they tend to pick up. Should investors expect to see any sort of uptick this summer, given the consumer concern and the economic damage that has been done because of the coronavirus pandemic?
Well, here's the one obviously beneficial thing to low oil prices is the fact that the consumer does benefit. You're exactly right. And the summer, from a driving perspective, from a filling up your tank perspective, is going to be outstanding for consumers. Gasoline prices across the U.S. are going to be very low, lowest we've probably seen in any summer for a long, long time,
But I guess
which
who's
is
going
great.
anywhere? Who's traveling right
Well,
now? If
it's
we still have
yeah,
stay-at-home orders in place through mid-May
yeah.
at least, and we're talking about a reopening of the economy that at earliest in some of the hot spots may happen in May, but then for the rest of the country who have not seen the same hit to their local economy just yet, as they've not kind of emerged as a hot spot, that could be delayed even more.
It could be. No, that's right. No, I mean that could be the case. But I think you're starting to see as these stay-at-home orders start to we move beyond those down the road. I mean, what we've seen in the past is consumers do respond to low gasoline prices and do drive. Now, yeah, maybe it's not going to be next week or next month, but in June, July, August. I mean, obviously road trips could be a very popular way of moving around and getting around because of the fact that jet fuel demand is probably not going to come back anytime soon until we have a better way to deal with COVID and a vaccine. But driving to different locations, that's something that definitely could happen. You've already started to see in China. That's one data point that we can follow. China, at least from a refinery demand perspective and oil demand perspective, is back up to pre-COVID levels in terms of demand. And so we'll see if that carries over to the U.S. But we think that could be an opportunity. And we do know that clearly for the consumer, it's great that we're going to have low gasoline prices for a while.
All right, Rob Thummel, who is the portfolio manager at Tortoise Advisors. Thank you so much for taking the time here today. We